Okay, tax students, here in this chapter we're going to be learning more deductions, here called losses and bad debts. We've seen deductions in previous chapters and we're going to see more in a future chapter. But here in chapter 8, we're kind of looking at specialized cases where we can have deductions. We've seen the general rule before in claiming deductions. Well, the general rule for income was everything is taxable unless specifically excluded. And in the case of deductions or losses, generally they're not allowed unless specifically stated that they can be claimed. Now, as a big general rule, if the property is used for personal use, that means it's not a trade or business or not investment, and that property is sold or exchanged or disposed of at a loss. Again, the general rule is that the loss is not deductible. There are exceptions, like it mentions here, casualty losses, and we'll see that later in this slideshow. But again, the general rule, like for example, the sale of your automobile. Of course, you're going to sell it for less than what you bought it for, and you're going to have a loss, but the loss is not deductible because you use that automobile for personal use versus using it for a trade or business. And you definitely didn't buy your car as an investment. Uh, Most people don't do that. Now, some people think of their home, the way they live, as an investment. That's really not an investment for tax purposes. Your home, your house, your condo, the apartment you bought is personal use property. Real property that's personal use. Okay. So we're going to see that trade or business losses is probably the best type of loss you can have from your operating your business, because now you can use that loss to offset any type of income unless it falls under something called passive loss rules. And we've seen in the previous chapter capital gains and losses here from selling investments. The capital losses can be only used to the extent of capital gains. And if you have extra capital losses, up to 3,000 per year can be used to offset other income, like the trade or business or portfolio income, and stock dividends or your salary or wage. But any unused capital losses after that can be carried forward indefinitely up to the last tax return before the taxpayer passes away. Of course, subject each year to deducting capital gains and then another 3,000 to offset other income. Well, we'll see in a future chapter, chapter 13, where we have trade or business property, not really through the operations, when we have a loss or a gain, and maybe we get the best of both worlds. That's called a Section 1231 gain or loss. So we've seen this formula before. We have a sales price we sell something at, or how much we get by disposing of an asset, and we subtract out selling expenses like sales commissions, contract fees, legal fees to get all that paperwork done. And the difference here is called amount realized. And then from this amount, basically, most times this is like cash you receive or any benefit you receive after the expenses. We subtract out the taxpayer's adjusted basis. Sometimes this is the purchase price the taxpayer had bought the asset at. Or in the case of a business asset that's depreciable, this would be the book value of the asset. To get either a gain, which we know is probably taxable, or a loss that we may be talking about in more detail in this chapter 8. So let's go back to stocks and bonds that we had sold in the previous chapter for capital gains and losses. So we know if you sell a stock at a loss, that's a capital loss, and depending upon the holding period, it could be either short or long term. And if it's a a loss can be only offsetting capital gains, and again another 3,000 during the year to offset other income. But let's say the stock goes down in value during the year. It still has some value, but it's just gone down. The stock market has gone down. Well, you cannot deduct that decrease in value unless during the year the stock turns completely worthless, or that security, the mutual fund, the bond, goes completely worthless during the year, zero value. Then you can say that you disposed of this security at the last day of your year, probably December 31st. And what you get to deduct is a sales price. Well, sales price would be zero, but then you subtract out your adjusted basis and you'll get a loss, probably again a capital loss. But in this case, the price has to be zero. The value, the fair market value of that asset at the last day of the year is completely worthless. If it still has some value, you cannot take this deduction. You have to wait to either goes worthless or sell it. Document it as a sale so you can claim that loss. Okay, so that's and you gotta use this date, yeah, the December 31st date as the date of disposition. So the date will determine whether you have something short term or long term. Let's say that you buy a property. Here's the land, and here's a building sitting on the land. Here's the door. And then your intent when you purchase this land is to demolish the building. So typically we've seen in previous classes, maybe even in our tax class, that you have to allocate the cost purchase price between the depreciable building and improvements and the land that is not depreciable. But if your intent was to demolish the building, then the whole cost of the property is allocated to the land and then nothing to the building. And you know that demolition cost to knock down the building? You cannot deduct that. That type of cost has to be capitalized and added into the cost of the land. And again, keeping in mind, whatever you allocate to the land costs just will sit there in your books. You can't depreciate it. The only benefit you'll get is when you dispose of the whole property and you get to deduct that land cost. We've seen, I believe, in that capital gain chapter, a section 1202 stock, where you initially issued stock on a new business, and eventually, if you meet the requirements, I think it's like a 5-year or more holding period, you get to exclude some of that gain. But how about if you have a loss on a small business corporation stock? Here it says up to $50,000 of the loss can be treated as an ordinary loss, not a capital gain loss like I had mentioned, subject to offsetting just capital gains and another 3,000. So they're trying to promote people to invest in small businesses, the tax rules, to benefit if you have a gain or benefit even if you have a loss. If the loss is more than 50,000 for the year, the excess loss is a capital loss and not an ordinary loss. Again, that's section 1244 stock. Another type of loss, business loss, may be restricted. It's called passive loss limitation rules under this section 469. And to be able to implement this passive loss limitation rules, we have to divide up a taxpayer's income into these 3 different categories. Active income is basically where you're working. I guess that's what active implies, like your wage or salary income, or more so maybe your business income where you put in your labor, put in your services. It could even be your share of the partnership income where you work as a partner, active partner. Portfolio income, the second group here of different types of income, is basically, let me put the description here. This could be wage, this could be trade, or business where you're actively working. Here they call it material participation, which we'll see a definition of on the next slide. Portfolio income, the second category of income. The main ones here, of course, is interest income, dividend income, probably capital gain income, where you're investing money and hopefully making money. Now, passive income or losses, again, you're investing, but you're not putting in any active service like this type of business. So this could be a business here. This passive activity could be a trade or business, but you're not working here. You're just an investor, or you're holding an investment, something like rental property, that production of income activity versus a trade or business. A rental operations would be a passive activity. Now, if you have losses generated by this passive activity, the losses can only be used against passive activities that have a gain or income. And any unused losses after that cannot be used to offset your other income here or here. Okay, there's exceptions. The only time now you can use any what we call suspended losses is when you get rid of the passive activity. Probably sell it, dispose of it, like sell that rental property. And any rental losses in the past years that you couldn't use are now released to offset your income for that year that you dispose of the passive activity. Again, this is called passive loss limitation rules. And if you have to decide whether the loss is an active loss from this type of business or a passive loss, again, you got to meet this material participation test here on the next slide. Like if you work more than 500 hours in a year in that activity, that's considered to be material participation, material activity, and now the loss is deductible. Or if you're the only person in that business, you're the owner, like a Schedule C sole proprietorship, and you do all of that work, and it has a loss. Now that loss is fully deductible, not subject to the passive loss limitation rules. And here's some other exceptions, yeah, to be material participation. By definition, losses coming to a limited partner from a limited partnership is a passive loss. And again, you can only use it to offset passive income until you get rid of that partnership interest. You sell it, then you'll release those suspended passive losses. Here's a couple exceptions that are not common. Now, the main exception to limiting passive losses is if the loss is generated by a rental operation. You own a rental unit, and here in Hawaii, because of the high mortgage, the interest, depreciation, operating expenses, probably is going to be less than the rent you collect, generating a rental loss, a passive loss. And again, the general rule is that you can use passive losses to only offset passive income. But a main exception to that is, again, if it's a rental loss, up to 25,000 of the loss for the year can be deducted if the taxpayer is an active participant in that activity. This is not the same thing as material participation or material, yeah, this one for the active business. We're still looking at a rental here, but in the case of active participation as a taxpayer owner, basically you have the oversight of, let's say, hiring a property manager. You can maybe screen tenants, but you don't get involved with the day-to-day activity. You can leave that up to a property manager, or you could do all the management yourself. Yeah, that all of that will still meet this active participation here. Also, the taxpayer has to be at least a 10% owner in that rental property. Okay, now you can deduct up to 25,000. Anything over that gets suspended or can be used to offset other passive income for the year. Now there is a AGI phase out. Here it says if your AGI is under 100,000, you get to deduct up to that 25,000 limit. But if your AGI goes over 150,000, then the limit is zero. You get to deduct nothing for that year, at least under this exception. So let's say that your AGI falls right in the middle here. It's 125,000. That means your limit for the year in deducting this rental loss is 12,500. Yeah, halfway through the phase out range, half of the limitation here. So here's the form we use to calculate out the passive loss limitation. Here's where you calculate rental passive losses. So here's rental passive income and rental passive losses for the year, and also deducting any suspended losses from prior years because of those limitations to get the net rental income or loss. If it's a net rental income, that means you're going to use up all of these losses here. If you have a loss over here, well, maybe you get to deduct it against other passive income over here. I've never seen this section here, this middle one here, yeah? So other passive income, the main ones here would be coming from limited partnership interest. Income from limited partnerships, losses from limited partnerships for the year, suspended losses from prior years, combining to a net income or loss for the year, including carryovers from prior years. And if this is a gain or this is loss, we can net it together to offset or use up more losses. Now, again, if we have a loss here, up to 25,000 of this rental loss can be deducted, but it's phased out based upon the taxpayer's AGI. Here it will be totally phased out if it reaches 150, and the phase out rate is at a 50% rate over 100,000. Now the loss is not directly put here onto the 1040, but it goes back to the form. Typically, in the case of a rental loss, this would go to a Schedule E. Same thing with this partnership losses on the page 2 of the Schedule E. This would be page 1 and this would be page 2. The losses of a passive activity have to offset passive income. Otherwise, it just gets carried over or here suspended to the next year to offset passive income for the next year. And then if you continually have passive losses, you'll probably get to use those suspended losses at the time you sell the property. And that may be good because when you sell it, hopefully you have a big gain, and that's the year you probably need to have deductions to benefit from the high tax bracket you may be taxed in. An exception to limiting passive losses for rental operations is if the taxpayer is already in the real estate business. The typical situation here would be a realtor, a real estate broker, real estate salesperson, even a developer, a contractor. And their main source of income is probably the commissions they earn by selling real estate. But they are also investing in real estate. And if they have rental losses, here if you meet this test, possibly those rental losses can be deducted right away and not treated as a passive activity, subject to the passive loss limitation rules we just saw. Let's change the type of loss, the topic here, and let's talk about casualty losses, theft losses. The general rule is that personal use property, there is no deduction on the sale. But if you have a casualty that destroys or damages the property, and we'll define what a casualty is, possibly we get to claim an itemized deduction. Remember, we covered itemized deductions in the last chapter 7, but we just briefly covered casualty losses. So here in chapter 8, we're going to calculate out casualty losses. So a casualty, here it says maybe it's come from a fire, like the wildfires in California right now, or hurricanes or earthquakes, okay? Accidents. So let's say that you got into a car accident and damaged your car. Well, that's a casualty. Okay? It has to be sudden, has to be unexpected. If it's slow in happening, like termite damage to your home or rust to your car, that's not sudden enough, yeah? There's no casualty loss there. So we'll see the calculation probably of casualty losses or losses in general of business property in chapter 13. But we'll focus on the personal use property. So what we got to do is take a look at the decrease in value to that property. So you look at the fair market value of the property before the casualty, and you look at the fair market value of the property after the casualty. So if the property is totally destroyed, this value here is 0, and you're looking really at the decrease, the reduction here, how much it went down in value. If it's totally destroyed, this would be 0, and you're looking at the value just before the destruction. But now you got to compare that with the taxpayer's adjusted basis in that property. And you're going to pick the lower of these two, the decrease in value or the adjusted basis. Okay, so that's going to be part of the calculation and how much you get to deduct. You cannot deduct these amounts here, yeah? We still have to go further in our calculations. Whatever those lesser of the amounts, again, the decrease in fair market value or the adjusted basis, you got to reduce it by the amount of insurance you get if it was insured property. Now, what's strange is if this insurance is bigger than the adjusted basis, the difference is going to be a gain that you may have to pay taxes on. And then there is going to be no loss to claim, to deduct. We're assuming here the lower of these two amounts here is still bigger than the insurance you claim. Okay, so let's call that a loss here. Now this is not what you get to deduct. For every casualty during the year, each casualty for the year, you have to reduce it by $100 floor. And this hasn't changed over the many years I prepared taxes. But this is just to get rid of the small losses. And then whatever is left over, let's call this net loss. This would be the loss for one casualty, like one earthquake, one tsunami. So you have to go through this calculation again for another casualty, itemizing out all the different assets here and combine the losses together here. And then the total loss after all of these adjustments is subtracted by 10% of the taxpayer's AGI. So this is the big hurdle to get over before anything is left over to be deductible as an itemized deduction on your Schedule A. So if you're not claiming itemized deductions, all of this is not worth anything. You got to be claiming itemized deductions to be able to claim this leftover amount. Here it mentions that this $100 reduction for each casualty. And then you combine all the casualties for the year together and reduce the whole thing by 10% of the taxpayer's AGI. Here's the form we use to calculate out the casualty loss for one casualty during the year. So for one casualty, you may have lots of different properties destroyed. Like let's say there's a fire. So here's the house. Here's the car that was parked in the garage. Here's all the furniture. Here's all your belongings. And we do that calculation for each category of asset here. The cost or the decrease in value, we take the lower of the two. It has to be reduced by the insurance you have over here. And then you combine all of these losses together and then you reduce it by $100 amount. Then you combine it with other casualties for the year on other Forms 4684s. And then you reduce it by the 10% of the taxpayer's adjusted gross income, hopefully leaving something over here that has to be claimed as an itemized deduction on Schedule A. So when do you claim this loss? It seems so obvious, yeah, you claim it when something is destroyed. But in the case of a theft, many times the theft is not discovered until years after the theft occurred or was occurring, especially if you're dealing with, let's say, money being stolen by an employee from the employer. Could be happening over many years. So you're not going to go back and claim it over the years. What you do is you combine the loss and you take it as a loss in the year that it was discovered. In the case of disasters and declared by the President of the U.S. as a national disaster, not only do you get federal benefits like from that federal emergency agency, but the IRS gets involved because it now allows you to deduct the loss either in the year it occurred. Let's say a loss happens right now. We're in 2017. Let's say that my house burns down. Well, to be able to claim the loss in 2017, I gotta wait for the year to get over. Now I can file my return for the year, and that'll be 2018. So to help me right now, what I can do is claim this loss, going through all that calculations we just saw, and amend my 2016 return and get back a refund for that loss. Even though the loss happened here in 2017, I cannot wait. I need the money now. I can tell my accountant, or now you, to prepare a Form 1040X. We'll see this in the last slide of this presentation, to report the loss here and claim a refund. Sometimes insurance is slow in paying you off, but you gotta put in an estimated amount you're going to recover. And if you get less than you expected, then you can go back and amend the return. If you get more than what you expected, you can depends. I think it's something based on materiality. Either claim it as income at the time you receive the money or go back and amend the return again. Let's talk about bad debts, a topic that you've probably seen in previous accounting courses. Here, for tax purposes, we have to determine whether a bad debt is either business related or non-business related. Business related means that typically it's a customer that owes you money, now you can't collect. Or you're possibly in the business of lending money, and now you can't collect from that borrower. Non-business bad debts, you're not in the business of lending money, but you still lend money to somebody as an investment, and you expect it to be repaid. So you make them sign a promissory note. Okay, make sure that this non-business bad debt is not a gift to a relative or a friend. You have to be able to claim a deduction. But both are handled differently, business and non-business. So let's take a look at business bad debts. So what we learned in previous accounting classes is the accounting for bad debts using the accrual method of accounting. Now, in real life, many taxpayers don't use accrual basis but use cash basis method of accounting. So let's actually use debit and credits here. Something we don't talk about yet in a tax class, but you guys know about it, how to increase or decrease accounts with debits and credits. And when you make a sale of merchandise, so when you Sell your services. We learned the accrue basis method of accounting has to record the revenue right away. So we debit the amount receivable from the customer and credit our fees or sales revenue account. Here's what you gotta pay taxes on in the year that you do this entry versus a cash basis method taxpayer. They don't do anything because they haven't collected the money. Even though they do have a legitimate receivable from their customer, they don't report any revenue until they have it in their hands. So let's collect the money. In the case of a accrue basis taxpayer, here's debit cash, a favorite thing to debit, and now the customer doesn't owe you the receivable anymore, so we reduce that asset with a credit. The cash basis method taxpayer got the money too, and now they report the revenue and pay taxes on this money versus the accrue basis would have to pay taxes possibly earlier in the year or at least recognize revenue earlier. But let's say this did not happen. You didn't collect the money. You made the sale, journalizing it here, expecting it also over here, but later on. But now the customer disappears. The customer goes bankrupt. They can't pay you off. So you gotta write off this receivable. Now, what you learned in the financial accounting classes, not tax class, was the allowance method or the reserve method. You remember you made an adjusting entry at the end of the period to estimate using the percent aging method, percent of net sales method. Well, for tax purposes, you usually don't do that. Typically, for tax purposes, maybe banks, financial institutions that lend money can use that reserve allowance method. But most other businesses use the direct write-off method of getting rid of this receivable. So once you identify a receivable is going bad, now you write it off. Yeah, write off of the receivable. So you take off the receivable with a credit again, but you're not debiting cash. You didn't collect it. So what are you debiting? Well, our topic right here, bad debt expense. Now, you may still have an allowance for bad debts, but that's for your financial records. For tax records, there's nothing to journalize here for allowance. Here's your deduction offsetting this income. You still got to report this income even though you didn't collect the money, but now it's going to be offset by this deduction. So it nets out to zero. So what's our deduction here for our cash basis taxpayer? Correct, nothing. Even though our cash basis taxpayer is economically worse off, like our accrue basis, because there was no sale reported like over here, there is no deduction, no bad debt to deduct. So you're ending up in the same place like this accrue basis taxpayer. Again, if your cash basis, there's no such thing as recording a bad debt expense, a bad debt deduction. It's only for accrue basis that had already recorded the revenue. Or again, if you're a bank, you lend the money, you're going to credit cash and you're not going to get the cash back. So you have the receivable here or note receivable that you have to write off. Now you have a bad debt expense. And that's the situation really for a non-business bad debt. So let's say you as a taxpayer, you're not in the business of lending money, but you're going to lend money. Again, you're the taxpayer. And here's the money going to the borrower. Okay, here's money. Now, why are you giving this person money? You expect it back? If not, it's a gift. If you expect it back, what you gotta do is take back a promissory note, a note receivable to you, the taxpayer, a note payable to the borrower, showing how much was borrowed, showing an interest rate that you're going to charge, showing the due date, the term of the loan, when it has to be paid back. This is typically what a lender would do, put it documented, yeah? If you're a legitimate lender expecting it back. So let's say now the borrower doesn't pay you back, bankrupt, missing, disappeared, no money at all. Other people standing in line before you to collect money from this borrower. Well, if it's totally worthless, we can probably take a loss for the basis of this note, which is the money we had lent. But in the case of a non-business loan, a non-business bad debt, this loss will be treated as a short-term capital loss, no matter how long this loan was outstanding. Yeah? Short-term capital loss can be used to offset only long capital gains, and again another 3,000 per year. Let's talk about business operating losses. So typically you hope that your revenue from your business will be larger than the expenses for your business. But if the expenses are bigger than the revenue, you'll have a loss, a business loss now. Typically this type of loss, business loss, for an individual is reported on a Schedule C, a sole proprietorship, um, maybe a limited liability company, a sole limited liability company, one member. Or maybe you're a partner in a partnership that you have that so-called material participation, your work time, and it's generating losses for you. This is not subject to the passive loss limitation rules, right? You had uh, materially participated, so the loss can be used to offset other income you have for the year. Maybe your wage income, interest income, retirement income. But let's say those losses you have is still more than you need for the year. Well, that's generating a current year net operating loss that you can carry back 2 years. So if you have a loss here in the current year, we're saying it's 2016, and you offset all the other income, you still have losses left over. You can now carry back the loss 2 years ago to 2014 and claim a refund for that year. And if you still have extra losses, you carry it over to 2015, 1 year ago from the loss year. And if you still have losses left over, now you jump to next year, 2017, and the next 19 more years before this NOL will disappear. A rule that you can use to forego the carry back here and just carry it over for the next 20 years. You can attach an election statement to your 2016 return saying that you forego the carryback and just will carry forward the NOL. Why would you do that? Well, maybe you're in a low tax bracket here, and any more deductions, including an NOL carryback, will result in a small refund, and you're optimistic to be in a high tax bracket here, so the NOL, the deduction, is worth more to you here. Higher percent tax rate, yeah? More tax savings with any deduction. So here's the general rule about the carry forward and carry back. This also applies to corporations, yeah? Here it says that the older, if you can carry back losses to 1 year from different years, you use the older losses first before they run out, yeah? So here's the forms you can use to carry back losses. Instead of amending the return to carry back, there's a special form called a 1045 for individuals and 1139 for corporations. And here you would calculate for each year you carry back the amount of loss. Keep in mind, in the case of corporations, not only can you carry back NOLs, but you can also carry back here first, before NOLs, capital losses. In the case of individuals, you don't carry back capital losses, you just carry them forward indefinitely. In the case of corporations, I believe you can carry back capital losses 3 years, NOLs 2 years. That's the generals. There's always exceptions to that. Yeah, and you have to carry any excess over to future years. In the case of corporations, the capital losses will expire, I think, in 5, something like that, years 20 for NOLs. You have to file this 1045 and 1139 within 1 year of the year after the loss. So in the case of a loss NOL for 2016, you have to use this form by December 31st, 2017 to carry back to 2 years back, 2014 and 2015. Same thing with the corporate carryback. Otherwise, to carry back a loss after that 1 year period has expired, you have to use the amended tax forms, 1040X for individuals and 1120X for C corporations. Now, calculating the NOL is not as simple as just looking at the negative amount of your taxable income. There are schedules included in the 1045, which is probably more complex than the corporate NOL calculation. And we have an example in our textbook in Chapter 9, kind of following this format in calculating the loss for the year, the NOL for the lost year. Then you have to calculate how much of the loss is absorbed in past years and future years. Again, it's not an apparent amount. Yeah, you have to go through a detailed calculations. There's even more calculations in the instructions to these forms. So typically not something that you come across every day, but when you do come across it, you probably have to refer to the instructions and now the textbook that we've been studying for examples. All right, that's it for Chapter 8. Contact me if you have questions. Make sure you work on your dynamics study modules and your homework problem.